the music, you know what time it is. 1 o'clock on the East Coast. This is a special market. Every day is special, Dan.
It is. But today
Every
in
day is
particular.
special. But today in particular. You know, it's high praise the fact that anybody watches what we do, be it here on Market Call, listens on the tape, anything that we do, Fast Money, all those things. It's always high praise. It's even more so when somebody that you respect in the industry, somebody's been doing it for quite a long time that is revered, actually watches and listens and respects you in like fashion. And that would be, of course, Doug Kass. But before we get to Doug, today's Market Call brought to you by FactSet, financial data and analytics powered by tomorrow. A lot to talk about. I mentioned in my tease that the Giants have very quietly built the best defensive line in football. I know you don't want to talk about that. How are you, Dan?
I'm doing well. I mean, listen, you know, one of the things, I'm just going to tell a quick story about Doug Kass, the aforementioned, who's going to be joining us in absolutely just a few seconds here. But I started in the business in 1997 at a hedge fund. I happened to be out to dinner one night on the Upper East Side, and Doug will probably recall what restaurant that was. Doug came over to the table I was at with a guy that I worked for this hedge fund, introduced himself. He had written an article in Barron's. This was in 1998 as the internet bubble was just bubbling up. And, you know, we use that term bubble and people think it's like a really negative connotation. You could have been investing in internet stocks in 97, 98, 99. It wasn't until the bubble popped, right? But Doug actually had a great write-up in Barron's talking about the zeitgeist, the moment that was going on in the markets, okay, but also highlighting some of the people that were, it was called Kids Today, and we'll try to find it, and we'll put it in the show notes. It was absolutely brilliant, and it was talking about some of the people in the markets. One of them happened to be the guy that I worked for. So flash forward 2011 or 12, I'm doing Fast Money with you. I haven't seen Doug since then. I've been reading him on Real Money. He's all over the place. And I think he called into the show that day and said something about it. And he and I emailed afterwards. And it's been since then 10, 11 years of emailing almost every day and the commentary. And the guy's a genius. Without further ado,
bring him in.
Bring him in. Doug Kass, founding partner, Seabreeze. Oh, there he is. Doug, we quote you. You know this every day. We love your work. You got a legendary career. You're not done. You're still doing it as well as you've ever done. At least I can tell from your commentary, and I see your returns at Seabreeze. So welcome to Market Call, and thanks for being here.
Thank you. Long time, first time.
Do you remember, Doug? Do you remember that article, Kids Today? It was.
I wrote this book. I wrote this. I've written 8 editorials for Barron's in the Other Voices section over the years. I think I was Alan Abelson's favorite. Barton Biggs and I were Alan's favorite money managers. And I think I was quoted probably twice as many times as Barton Biggs, which is embarrassing considering his career relative to my career. I'm not worthy. And so I wrote this piece in 1998 called Kids Today. And it was basically paying homage to one of my dear friends who had died, Bob Brimberg. He was known as Scarsdale Fats. And there was a chapter on him in The Money Game. Remember Adam Smith's famous book in the 1960s? Actually, that got me involved in the investment business. And I talked about how in the dot-com mania, it would morph into a bust, and there would only be one recognizable money manager who was successful during it that existed and would flourish, and that was your boss, Stevie Cohn. And I talked about his kid, Adam, meaning Adam Sender. And that was one of the most fun editorials I've ever written. If you can find it, it'd be great for viewers.
As they say, Doug, we will find it and we'll put it in the show notes. Is that a thing?
Yeah, but guy, you know, you use this term prescient. So Doug wrote this in 98, and he's basically laying out, you didn't say the bubble was about to pop. You recognized the bubble. You recognized the market participants who were there to take advantage of just the new dynamics of this market, right? And the changing kind of, you know, interest in a whole different sector of stocks, that sort of thing. And I did have a front row seat for it in 97 and 98, and there were a few better than it. I think what's interesting, Doug, is that you recognize the fact that these sorts of market participants are going to adapt to different market environments, right, at the time. But the ones that get sucked in, the Johnny-come-latelys, it's going to end very badly. And that was the case.
That was the case. And I know Howard Marks has this wonderful commentary at Oak Tree Capital periodically, and he wrote in his most recent column, testing the temperature of the market, he said, quote, "Remember, in extreme times, because of the above, the secret to making money lies in being a contrarian and not Mormon." And that's really very important. And it's one of the most important lessons besides the lesson I just gave your daughter, Ellie.
Which we did before the show started. Ellie's going to be a senior in high school this year. That's Dan's youngest daughter. So let's talk about the market real quick. 30,000 feet perspective. You know, I think you know the views that Dan and I both share. I think in some ways we echo some of the things you've been saying. In other ways, we probably have some disagreements. My view has been everything is predicated off sort of the global bond market, Dougie, and the unraveling of the bond market, not only here, in my opinion, in the United States, but globally, I think is at the crux of everything. What am I misreading this, or is that as important as I make it out to be?
No, you're not. One of the things I like about you guys, and I mentioned to Dan's daughter, is that you admit when you're wrong and you explain why you're wrong, and we try to learn from why we're wrong. And I was wrong too in that from March. Without going into it, I thought the market, I had a contrarian view that the market would experience 5-10% up in the first half and then lose it all and then more in the second half. And what got me off base was the move from March to June, when I would say that the equity market started the summer as a voting machine with FOMO and animal spirits delighted. It's ending the summer as a weighing machine. With the prospects for, I think, starker than consensus corporate profits, slowing global economic reality, the resumption of commodities inflation, the continuance of a wage price spiral, and higher interest rates, both real and absolute. And let me just frame by saying that I run a hedge fund. I do a couple things. I still write for TheStreet.com, which Jim Cramer founded. I teach advanced economics in the second year MBA at Yale School of Management. I teach in Dr. Schiller's course, and I run a hedge fund. I had my hedge fund until 2013, and we were prospering, growing assets, and performing well, which is more important than growing assets to me. And then I was struck with prostate cancer, and things got bad, and I didn't know what the future held, so I redeemed out all my investors. And I planned, when I got better, to resume the hedge fund. Of course, then COVID hit. But I started up about 2 years ago, Seabreeze Partners, and that's what I'm doing right now. So everything I'm talking about, I'm doing at Seabreeze. It's not paper trading.
So let me stop you for 1 second and say this. You know, the word "but for" that Carter uses all the time, but for Silicon Valley Bank in March, my sense is, and again, you can't do the counterfactual, but your prognostications, I think, would have been spot on, somewhat counterintuitive. But what happened with those regional banks were the best thing that happened to the market for about 4 or 5 months. Thoughts on that?
That's what I missed, and I think you guys missed. I missed that the liquidity added from the regional bank crisis would create that supercharged FOMO liquidity-driven advance from March to, say, June. That's what I missed. The interesting thing in my hedge fund, you know, we were profitable last year when everyone lost 20 or 30%, and we're more than profitable. We're doing better than we did last year in 2023. And I was actually, something few people talk about is how you manage a hedge fund when your narrative is wrong. And we actually made a small amount of money being net short from March to June, in that, you know, when the market went from up 7% to up 18 or 19%. So that was good risk management. And that's really important to me. But I think that we're now, to answer your question, in an aging business cycle with very restrictive monetary policy. We have a still rising cost of capital, which is going to lead to loan reset problems. We're lapping very easy fiscal policy. We had $2.5 trillion of excess consumer savings, which have been depleted to a couple of $100 billion. So household liquidity is rapidly eroding at a time in which there is an increasing risk of recession over there in Germany and in the rest of Europe, and importantly, at the engine of global economic growth, China. So our economy has, until recently, diverged from overseas economies as the lags in monetary policy transmission have widened, but the impact has not been repealed. Remember, we started the year with defensive market positioning as there was a universal belief that stocks would move lower. So we had the FOMO, we had the animal spirits, it reversed the conservative positioning. That's changed. The downbeat market expectations have become morphed into a bull market in complacency, and positioning is now offensive, literally and figuratively. And as you said, the appreciation in stocks since March has occurred despite a sharp rise in interest rates. And that's where you and us three have been wrong. But I don't think the gap between and PE ratios is sustainable. And I suspect we're now facing a mean reversion in valuation ahead.
So Doug, you hear us say things like Doug Kass has forgotten more about investing in banks and analyzing bank stocks than we'll ever know. Okay. And so it's interesting to us that, coming out of that period in March and April, after that liquidity was provided, we saw some of the money center banks get back on their horses. They were clearly the beneficiary of some of the things that went on with some of their smaller sort of brethren. But we're starting to see now, and Guy's been talking about this, I think, fairly succinctly, and I know you've been writing about it a bit, is that, with interest rates going higher, some of the very problems that took down the regional banks, right? These held to maturity, mark to market situations, it's only going to become that much worse for some of these. Like there's a reason, in my opinion, that Bank America lags, let's say, JP Morgan, it's down 15% in the year versus JP up 10% in the year versus Wells Fargo flat on the year. Citigroup is down 10% in the year. Market participants are making judgments about the very thing that took down some of the largest regionals just a few months ago. Talk to us a little bit about that. And then let's get to the offensive part to the double entendre that benefited just from the liquidity, the movement into some of the tech stocks, right? But we're seeing a lot of these banks round trip those moves since mid-July after they reported. What is your take here? And are we likely to see another set of palpitations as it relates to our financial institutions, especially if rates continue to march higher?
Okay. One of the only industries I think I know well is banking. I probably am the only hedge fund manager who was a nader raider. You youngins, Dan, you wouldn't even know what a nader raider is. I'm sure Guy does, being from Georgetown because he was based in Washington. And when I was in my second year at Wharton in business school, I co-wrote a book with Ralph called Citibank. And then I ended up following the financials at Putnam. And I voted me number one bank analyst on the buy side. So it's an area I know. I don't understand technology very well. I don't understand commodities that well. I don't understand a lot very well, but banks I know. I was long the banks into early, let's say, February 2023. They had a very strong run, as you remembered. And then as the Fed intensified its tightening, both in duration, in timing, and in magnitude, I was concerned about the potential for the deposit beta issue, migration of deposits out of banks and other financial intermediaries into money market funds and what it would do for the net interest income. And I sold the banks and then began to short some of the banks and have avoided them. It's simply the wrong stage of the economic cycle to own banks, and it's complicated by the likelihood that the Fed will be higher for longer. I think that the banks are, everyone uses banks and energy stocks and the Russell as value stocks. And the general consensus has been that the advance in the S&P would be confirmed by a broadening out of the market into energy, financials, and the Russell. Well, the Russell isn't growing. Energy stocks are doing poorly, and banks have, as Dan just said, have made an round trip.
Mm-hmm.
This is all complicated, finally, by the complexities and costs of the new regulatory move. See, the negative side, the positive side was the liquidity guy that was introduced in the financial system that developed into animal spirits and FOMO in general. The negative is that it's going to lead to complex and costly regulations for the banking industry, whereas the non-bank financial intermediaries are free of regulation, and they're going to benefit and gain market share. So I don't like the banks at all. I think they are shorts.
It's interesting. I obviously agree with you for a while, and I've said that people will look at banks and talk about price to earnings and reasonable on valuation, all those different things. I think what they're not taking into consideration is, first of all, they've all become to a certain extent utilities, and more regulation is coming. I think credit is going to be tighter, and maybe the need for credit. I mean, I think, if things were to slow down in a meaningful way, that's obviously not particularly good for banks either. And I think a lot of them, quite frankly, have gotten lazy over the last decade or so, not understanding what duration risk really means. So the fact that we have not got any more headlines from some of these small and regional banks doesn't mean they're not more coming. So I think there's a shoe to drop there as well. That's just my belief. In terms of
especially the regional banks are important lenders to small and medium-sized companies.
Exactly.
And these are companies that face this loan rate reset cliff, and they're going to be a lot less profitable. Their coverage is deteriorating. I read where the Russell index, if rates stay where they are in 2025, I think it was Bianco said this yesterday in a tweet, the IWM will lose 1/3 of its profits just on rising interest costs,
which is remarkable. So let me then continue that, because I agree with you. So small and mid-sized companies in the United States employ, I think, and you know better than I do, 70% or so of the people that are employed in the country. So if you start to do that, if our economy is 65-70% driven by people buying shit, by the consumer, and if those people are going to be somewhat mitigated or hamstrung by their employers and by these regional banks, I don't know how that's a bullish scenario for the equity market.
And think about the Federal Reserve, which faces this trilemma: the challenge of simultaneously reducing inflation, and we could go on. I think the only one who hates the Fed more than me is you.
Yeah, I'll take that mantle. Yes,
minimizing, as you just discussed, minimizing the hit to economic growth and jobs, and maintaining the stability of the financial system. They screw it up so badly. In fact, the mistake in keeping interest rates and doing this kind of a priori policy back then, which is now morphed into the opposite ex post analysis.
A posteriori, but yes.
Posteriori, correct. And this feeds at the valuation risk in the market, and the likelihood that I'm less concerned. I've always been less concerned about a recession and an extended period of what I call slugflation, sluggish economic growth, and prickly inflation for many, many years. I mean, if you think about it, I just read a Federal Reserve a column on the Federal Reserve website, in which it said that lower effective tax rates for corporations and lower interest expenses in the last 15 years has contributed to 55% to 60% of the corporate profit growth. And that's reversing. And then you superimpose upon that something you guys have been talking about, deglobalization, which essentially serves to increase the expenses of corporations. This is a real problem in terms of sluggish growth. And then deglobalization, think about it. China has been the engine of global economic growth, and the beneficiary of globalization, as they lose those orders, and you see that in their weakening net exports, that hurts, obviously, the Chinese economy as well.
Yeah. And Doug, that brings us to that offensive part of the stock market this year, right? So when we had this kind of liquidity added to the system in March and in April, it found its way into some of the highest valuation tech stocks, which happen to be some of the biggest stocks in the entire stock market, which also seem to be gripped by a mania in and around the interest in AI. And, one of the things that I always find kind of interesting, we sit here and we stare at our FactSet machine all day and we watch every tick in, hundreds of stocks, and we're watching different, financial instruments and this and that, whatever. But I also, and this is one of the saddest things about me not being on Twitter anymore, because it was a great place to curate lists of folks, right? So I had, 24 guys and gals like Doug who are just market participants who are saying this, and they're always very careful about what they're saying, things when, and then you get these news headlines from these organizations. It was just a great place to get a really good, snapshot, I guess, of the vibe, of the mood in the markets, that sort of thing. So I missed that a little bit, but we obviously text and email a bunch. You were not that quick to jump on the bubble saying it's going to pop soon. You know what I mean? I think some of the work that I at least read from you on Real Money is that you wanted to see a cycle. You kind of waited until that Nvidia report and this, but then you started layering things that some techies might say, well, it's a bit normy from some old guys on Wall Street to say, and I'm just being really honest to say this, but this is on the margin how these sentiment shifts take hold in the markets, right? It's like you have to start thinking about. So you've been writing about chatbots really for the last couple of months, not before May 25th or whatever Nvidia gave that report, but afterwards. You've been tracking the data about how you're seeing the usage decline and some of the other anecdotal things. And what's happened? Microsoft sold off 10%. A lot of things are starting to confirm the fact that this might have been a moment in time. Now, we could all agree there's going to be a massive secular shift that is going to take place in the economy on the back of this sort of technology, but the stock market pulled forward a lot of that excitement. Speak to this and how your thought process has changed over the last few months and how you're positioning, because tonight, Guy and I have been saying it, we've been saying it on CNBC, we've been saying it here. This is going to be a really important 24 hours for this trade, in my opinion. And it could have months, if not years, of ramifications, in my opinion.
Yeah, I have called in recent weeks ChatGPT. I've called it an elegant parlor game that is going to produce limited revenues and abundance of higher costs for corporations. And about an hour ago, I sent you Paul Kedrowski's Substack. You should provide your viewers with a link to that. It's really informative, and Paul knows more than you and I have ever known about in technology. And he comes to the same conclusion. So I will leave it there. I just think it's not new. I remember when I started the series of columns on Real Money about 2 months ago, I started with the cover of Forbes, which talked about AI in 1995. And then actually underneath had a picture of a woman who was a CEO of, what is that computer? It was a laptop seller. And it said this company was going to destroy Dell.
Compaq.
Yeah. So it was a double mistake. So, emotion, it's something else Howard Marks talked about in his last commentary at Oaktree. Investors' emotions go to and fro. And our job, as I did in that Kids Today article in 1998 in Barron's in the editorial, the hardest thing is to judge when there's an overshoot. I believe that March, June, there was an overshoot in technology, which continues to this day.
So let's talk about, history sort of repeating itself. I think it was 99, 2000. I don't remember exactly when, but Sun Microsystems, Scott McNealy founded the company. the growth that the market was sort of rewarding them with was clearly unsustainable, to the point where he actually came out, I think, with a chalkboard or something and tried to explain to people how, in fact, it was unsustainable. And I think he did a great service. Nobody wanted to listen to him. But, that was an important company then. The same way Nvidia is an important company now. It's just the levels with which the market is taking it, to me, seem a bit extreme. So how important, again, in terms of market sentiment, do you think this Nvidia release is going to be this evening? And then obviously the subsequent price action.
I think the latter is more important. I forgot what technician, maybe it was Mendelssohn, said it's not the news that counts, it's how the market reacts to the news. Look, Nvidia is a great company. I wish I owned it at $150. They're going to beat the numbers. They're going to raise the bar. Everyone knows that. Let's see how the market responds. I don't have a crystal ball. I wish I did.
Yeah, it's interesting, and we've been talking about this, Doug, a little bit. I mean,
by the way, when I short stocks, Dan,
yeah,
as you know, I rarely short, high beta stocks, these .com stocks. And when I do, and I have a 3.5-hour lecture at Yale, which talks about the construct of short selling. I've always said that how you construct, and you're an options guy, how you construct a short sale is almost more important than the actual vehicle that you're shorting. So I do a lot of synthetic puts. I short, if it's a stock is volatile, I short stocks and define my risk by buying out of the money calls. Very simple.
Yeah. But listen, that's a really important distinction. I know, Doug, you hear me say this all the time. I don't believe retail investors should be shorting stocks. Okay, but I
always write in my columns. I'm very transparent on Real Money on the Street .com, and I say you shouldn't be doing what I'm doing. You shouldn't. Individual investors should not be selling stocks short for 3 reasons. Number one, the risk reward is asymmetric. You can lose an infinite amount on the upside, as Robert Wilson once learned in Resource International, but you can only make 100% if you find a fraud or a bankruptcy. The second thing is there's a gravitational pull higher in stocks over time. Stocks, depending upon your time frame, go up 6 to 8% per year. So that's a huge headwind. And the third issue, which is rarely discussed, Dan and Guy, is that if you're long a stock and it goes against you, it goes down, there is basically its weighting in your portfolio is being reduced. Yep. So you have basic risk control by virtue of mathematics.
Right.
If you're short a stock and it goes against you, it goes higher, it becomes a larger weighting in your portfolio. Ergo, short selling is only for professionals who don't play golf during the week, are at the trading desk 14 hours a day, and that can control risk.
So here's sort of not a market comment for you, but just sort of what we deal with, and I know what you deal with. So, and if Jay is responding to a comment from the comments, I didn't see it, but so Jay Rice in the comment is saying one company's quarter report will be felt for years could be one of the dumbest comments ever. Now, I know I didn't say that. I didn't hear Dan
I
said
just said it. I just said it could have ramifications. Okay. I think not by the market or this and that, whatever. I think it's something that we might remember because Guy,
but that's much different than, and I agree with you. It's something I remember things that happened decades ago and sort of.
Well, here, all right, hold on. So let me.
I agree with you.
All right,
that.
So put Jay's comment up there so I can see who we're talking about here. So Doug, I just want to go back to this point. I remember in the summer of 2000, and it just so happens, okay, that the company called ADI, okay, reported this morning they missed and they guided down. Now the stock's up, and that you'd say bad news. Good stock result. Okay, well, we get that. I remember in the summer of 2000, it was July, it was the Q2. ADI, they had a really bad miss when expectations were high. They guided down. That was it, man. That was it. I'm just telling you, the semi-cycle had turned. Something happened that Yahoo put one too many banner ads up on a web page there, and a whole bunch of, unprofitable, web-enabled.com, whatever, they went under. They stopped buying servers from Sun Microsystems. They stopped buying fiber optic from Lucent and this and that, whatever. And it was just from there on out, you could have shorted every rally. And I'll tell you, and we were back then, okay? And I go back to 2007. This was November. It was the first week. Cisco reported a very difficult, like a disappointing result in guidance. And I remember what that meant for the tech trade. There was still a lot of hopium in the market. This was the same thing back in 2000. So what I'm saying, Jay, and I appreciate it, you can call me as dumb as you want. I've just seen these cycles before, and I just look at what's going on under the surface in other parts of technology. And if Nvidia beats the number that they had guided to in late May that caused $1 trillion in market cap gains around a narrative, okay, around a narrative, and they guide up, okay, but they don't guide up enough to keep the stock going higher, something will have changed, in my opinion, for the whole tech trade. Because what I'm looking at under the hood, it's already starting to change, and this would be the confirmation of it. So that's kind of my answer to that. Doug, thoughts on that? Because to me, I got a very long memory about a lot of this stuff. And, you know, pattern recognition is probably one of, with a bit of nuance, one of the most important tools in my toolbox as I think about it from an investor, from a trader, and obviously from a pundit.
There's an old saying that bottoms are processes and tops are events.
Mm-hmm.
And I've done well buying stocks on dividend cuts or dividend eliminations, or a situation like ADI, and maybe a situation like Nvidia, who will be tonight, and you'll get an initial burst of enthusiasm, and tomorrow will look a lot different. Look, it's really hard. It's hard to put your thoughts transparently out in the business media, as some of us try to do. It's even harder to be transparent and take ownership of those things. But I agree with your observations 110%, Dan.
You know, I think and I understand it's human nature to want things to go. I understand everything that's sort of why people want the stock market. I get all those things. What I've learned is if you're just constantly bullish in the face of all the things that we've talked about, there are no ramifications for that, because you're sort of reinforcing people's belief system, and people like that to be in that echo chamber. I totally get it. When you then try to point out the things that can go wrong and the things that are concerning you, people don't want to hear it. They especially don't want to hear it if the market continues to fly in the face of that. And I understand if stocks go higher, the reasons why don't necessarily matter if you're long those stocks and you're making money. I totally get it. But to not point out the things that we try to do on a day-to-day basis, I don't think you're doing anybody a service. And if it makes just a few people think about things differently, then I think we've succeeded. And by the way, Doug, I think that's sort of what your mantra's been for many years now as well.
I despise perma bears as much as I despise perma.
Absolutely.
I like to think of myself as being honest, taking ownership, and an opportunistic contrarian with a calculator in my hand. By calculator in my hand is, I don't believe in these bullshit price targets. I believe in developing a set of scenarios for a company, a sector, or the markets, based from the most pessimistic to the most optimistic. Morgan Stanley's research does a good job weighing each scenario by attaching a probability to it and creating a range of expectations, not a single point price target. I think it's very presumptuous and implies a degree of precision that if you haven't been in this business, if you've been in this business for more than a month, doesn't exist.
Yeah. Well, you know, it's interesting. And I just want to tie this together, what you said about shorting and how you construct shorts, because that probability that you just kind of referenced there, assigning probabilities to outcomes, that's very much how I think about it from a trading perspective. And then if you're just doing some simple math, you kind of look and see, I had somebody just as a quick example. So let's just say hypothetically, I'm looking at my screen. Nvidia is what, 460 something right now. Mm-hmm. Okay. And I had a friend of mine hit me and say, hey, listen, I bought the October, this is out a couple months, Nvidia, a way downside put spread, isolating a move. See that gap? That's 305, right? That was where it closed the day before it reported earnings. So he's buying a put spread where he's long a put down near where the stock gapped to, okay, on that day. So if you just want to move the cursor up to, I think it was like 380 or something, and down to 350 or whatever the hell it is, just incorporate. He thinks that over the next few months, this stock is going to fill in that gap from May. I said, that's fine. You're dedicating a certain amount of premium, you're defining your risk, and you're playing for a level. I'll just tell you that the probabilities don't line up with the capital that you are deploying, playing for, where you're not even in the money until the thing goes down $100 or something like that. So to me, that's a low probability bet, right? You're using math, and I get it. He's better off taking that dollar amount that he's risking and just buy a far fewer amount of at the money puts or put spread.
I agree totally. As my grandma Koufax would say, "Rots a ruck" to that put play.
Right. But do you understand? So you know what I'm saying is like assigning probabilities of outcomes. And again, we don't have crystal balls. We just go with the crystal. We don't have crystal balls.
No, it's funny.
You see what I did there?
Crystal balls as opposed to steel balls.
Steel ball. There you go.
Neither one of them work.
That's where it's going. No, listen, Doug. We really appreciate what we want to do. I think because you watch or listen to us. This is a different vibe today than other days. I think you can tell the guy and I are really excited just to sit here in the middle of the day and shoot the shit with you about the markets because I view you've been a really great mentor. Not you and I've never sat on a trading desk together. We've never been at an idea dinner together, that sort of thing. But you've given me lots of color real time as I've been sitting on the seat at Fast Money, as we've been doing these sorts of things. And I really appreciate that because you are one of very few people. You started writing on the street in the late, is that correct? In the late 90s in the street.com. You were really early to this game.
This is my 26th year
wow.
writing for this. And it's funny. You have a second? I can tell you how it happened.
Yeah.
So I was friendly with this guy, David Kansas, who was the managing editor of the Wall Street Journal and wrote in the old days when we were youths, the Herd in the Street column was a very influential column. Remember, you wake up in the morning and say, what company did Kansas write about? Actually, Dan Dorfman did it before he went on to CNBC. And he called me up. He says, I'm leaving the Wall Street Journal. I'm going with a guy named Jim Cramer to start the street.com. I'm going to be the managing editor. I'd like you to write a contrarian article. And I started actually in June 1997. I've been there 26 years. I started as kind of a joke. But I actually find it helps my money management skills because I like to stack the pros and the cons like a balance sheet and write it. And more importantly, when I'm wrong, I go back to what I wrote in making a specific decision and to determine where I got it wrong, so I won't do it again. But I have been writing. I probably have written over 100 million words.
Well, you've helped me think about the kind of intersection between being an investor trader and a market pundit. And you can obviously tell that Guy and I enjoy it. You obviously enjoy it. You like the idea of helping people. You wouldn't still be doing it on the street for, after 26 years.
The only reason I do it, and that's why I teach at Yale.
Yeah. I mean, listen, and we have fun doing it. I will say this, and Guy, I don't know how you think about this, but, having to speak about the markets every day, some of the same stocks every day, it's actually, I think I've gotten better for my punditry, the way that we articulate things and hopefully explain things to people. And maybe that helps people think about it because they spend, far less time at it than we do for the most part, right? They're doctors, lawyers, bus drivers, whatever the heck they do. They don't have the time that we have. But it's really hard because in an effort to be really transparent, you can't change your mind so much on the margin. You know what I mean? Like on the little things. And because that's when you get into that talking out of both sides of your mouth sort of thing, Guy, Well, and Doug can speak to that. And I think Doug watches closely enough to understand when that's taking place. And you do call it out. I think for a lot of people that don't watch it as closely, again, it's easy to blow hot and cold each day. Market's up, you're bullish, market's down, you're bearish, and there are no real ramifications. If you can sleep with yourself doing that, more power to you. I, for one, know that I can't. So there has to be a level of consistency, understanding, though, that markets do change. And so everything is fluid in this world.
That's
we do our best. And I got to tell you something. Listen, I'm not cracking rocks every day, and I'm not digging ditches. So I'm not saying it's grueling physically. But believe me when I tell you, I mean, talking about this stuff on a day-to-day basis, I mean, it absolutely takes its toll.
The reason I like to write also is I believe in time stamping your ideas. I believe in memorializing your ideas. As you know, my greatest objection to financial TV is that the ideas are not memorialized. So the viewers or readers are unable to determine the value added of the particular panelist or contributor. And I still to this day don't understand why CNBC and Bloomberg don't hire 1 or 2 interns and just keep a running total of the recommendations and show in a disclosure how they've done. How else is a viewer or reader supposed to know whether Dan's contributions are worthwhile and value added? But I believe, and then I like taking ownership when I'm wrong, but also I like learning from being wrong, so I'm not wrong again.
Yeah, no, we get that. All right. Well, listen, Doug Kass, we really appreciate you spending time with us. We know that it is, a busy day, busy week in the markets, actually. So we really hope you'll come back. And the next time you're in New York City, we'd love to do a sit down face to face, in the studio here. But this was great. We really appreciate all of your opinions, thoughts on the markets. And again, I'm just going to reiterate this, over the years, just all of the, just all the commentary has been really helpful to me as I try to, get better at this every day. So thanks a lot, Doug.
You're on Mount Rushmore, Doug. You are a legend. You know how we feel about you. And again, we bring you on just so people can understand the level of rigor it takes to get to where you've been. And I use that word. To me, that's one of the biggest compliments I can pay somebody is, they're rigorous, and you clearly are on the top of the hill when it comes to that. So thank
you, guys. And I'll leave you with one ludicrous forecast because we have to say one thing about baseball. My prediction is within the next 2 weeks, Don Mattingly is named the New York Yankees manager.
All right, so let's just talk about that for a second.
You got his attention.
And I hear you. I see. Here's the problem I have with Don Mattingly being named. It's the same problem I had with Patrick Ewing being named head coach of Georgetown University. Unless your last name is Wooden or Krzyzewski or a handful of other people, you get hired in these jobs effectively to get fired. And it's very difficult to fire somebody that was so important to your franchise as a Don Mattingly. So I would steer clear of that. But I respect that opinion 100%.
The knock on Mattingly is that his 2 prior teams he was unsuccessful with. But if you remember, their rosters were very, very weak.
Dealt some difficult hands for sure. Now, I worry about that for a myriad of different reasons. But it would be not unlike, think about if the Yankees had hired Mickey Mantle in the early 1970s to be skipper, it would have been a disaster. Before we go, and you talk about this, the greatest left-handed pitcher of all time. I mean, people talk about Steve Carlton, but Sandy Koufax, clearly, injuries robbed him. It would have been in a tremendous career. But even with that, there was nobody more dominant over a 10-year period of time than him. You talk about Sandy Koufax, Grandma Koufax. Educate our listeners and viewers as to your relationship with the aforementioned.
Sandy's my first cousin. My grandfather was Harry Koufax, and my grandmother was Jean Koufax. My mother was Selma Koufax. And my greatest accomplishment I made through elementary school was that I was Sandy's cousin. It was really a 6-year period. It's really an extraordinary.
Yeah, no, there's 60. You're right. I think he played for 12, a couple of years. But I hear you.
What people don't remember is that his last year, 1966, guy, when his arm was falling off, and his doctor said if you pitched one more season, you might lose your arm. It might be amputated. He had 27 complete games. I think he won 25 of them.
Crazy. No, those numbers will never be matched. And, I think because he really took himself out of the public view, he signed, people don't remember this. I think he signed a 10-year contract with NBC Sports to do baseball. He lasted 4 or 5 years because he just didn't enjoy it. And you don't really, unless you go to Dodger camp, you're not seeing him all that much.
Little known fact, my grandfather advised him on some real estate purchases to use his excess funds, and he ended up buying a lot of property in West Hollywood, Los Angeles, and became very wealthy.
Good for him.
My people say Mazel Tov.
My people too. The other major accomplishment, Doug, is that you made it through 45 minutes and you just got one little yelp out of that dog over there. You seem to have a tremendous amount of poise. Oh, look at that guy. Daisy
is an English cream dachshund. And Ollie, so is Ollie.
Oh man, they are nice looking dogs.
Good for you.
All right, listen, go enjoy them, Doug. We really appreciate
Thanks
your
so much
time.
for having me, guys. Anytime you need me, I'm here for you.
You're the man. You guys know where to find him. Realmoney.com. He is the founder of Seabreeze Partners. Doug, thanks so much for being here. Thanks a lot.
Legend. He is. I mean, obviously we've known Doug a long time.
That was fun.
Absolutely. And, people say you bring him to reinforce. No, I mean, we bring him because I think it's an education, not only for the audience, but for us.
He does things really differently. I think the term you used was rigor. And I don't mean to say that you and I are not rigorous, but we're kind of like, we're kind of those guys, the color commentators a little bit here. You know what I mean? Like, and listen, you know what? I'm in the game. We're trading. We're doing things. We're coming up with ideas. We're putting our money where our mouth is. And let's go because we only got a couple minutes. We've gone really late here, guy. Let's look at Nvidia real quickly. Okay, so the stock is at 470. Yesterday it traded 480 briefly. It was
made an all-time high yesterday.
Yeah,
and then it traded 75 million shares, which I think is 1.5 times normal volume, closed effectively on the lows. It's bounced today.
Yeah.
And I said it on the show last night. I mean, there's a very good chance we go back and, as you said earlier, we go back and look at that move in Nvidia and say, sort of bookmark that was it. And then obviously it's higher today. All this can be erased. I totally get it. But to your point about Nvidia, let's bring up a chart and take a look.
Yeah, well, I mean, look. So here's the thing. Okay, if I didn't have a scale on that axis, you know what I'm saying, and it didn't look like a 300% gain from the lows,
you spread it out longer.
I'd say that's a good looking chart. I'd say, like, look at that gap, that consolidation, like we're going to gap up above that sort of thing. I mean, like, but I guess my point is that $1.1 trillion market cap here, and then you look at it that way and you say to yourself, who the hell else does not know that this company is going to blow the doors off the quarter and the guidance? And so, I said it on Fast Money last night, it could gap. It could be up, $50. And just, the options market is implying about a $50 move in either direction. How do I figure that out? I look at the 470 weekly strike call, the 470 weekly strike put. They are $25 each. You put them together. That is the at the money straddle. You take that $50 in premium, you divide it by the strike 470, and you get about 10.5%. That's what the options market is implying. This stock can move between now and Friday's close. Okay. And if you look at that, okay, $50 gets you back down towards that gap level. Doesn't even get you filling in the gap. So that's the other reason. I'll just say this about trading options into events where the premium is really elevated. You can get the direction right, but if you don't get the magnitude of the move right, you could lose money. And that's also very disappointing. So trading binary sort of setups like this are also very difficult. Listen, guy, the way I'm thinking about this is you get that move. In the aftermarket, it's going to be trading up, I suspect, unless it's just below the whisper number, But I think it gets sold either way. I just don't know who's left to buy it. Shorts are going to panic to cover, but who's the new long?
That's the thing. I'm not really sure there are that many shorts at this point. I mean, I think a lot of people probably swing. And I'll say this. I've missed in the almost 17 years we've been doing Fast Money. I missed one show, and I actually called in. It was in November of 2018. Governor Murphy had just been voted. He was in office for 6-7 months, whatever it was. There was this snowstorm seemingly out of the blue that New Jersey was not prepared for. I've never seen anything like it. It took me 5 hours to get to my house to Newark Airport, which is typically 20 minutes. And that's not hyperbole. I only remember the entire thing because it was on that day Nvidia reported earnings, and it was an unmitigated disaster. The stock, I think, went down about 28% in the after hours. So it's a much different company 5 years later. I get it. But this is a company that has a history of big moves to the upside post-earnings as well as to the downside. So it's anybody's guess what the interpretation of the market's going to be this
All right.
afternoon.
Do you think really quickly, like there's a decidedly different tone in mega cap tech today? I'm looking at Apple up 2.25%.
Rates are lower.
Yeah.
I get it.
It's weird. Microsoft up 2%. Like it just feels like the powers that be said they want to rip this stuff. Google's trading up 3%. Meta's up 3%. Netflix is up 5%. It's just a kind of a weird day. And, again, is this a head fake? Do you want to be careful? And did somebody get the call that Nvidia is going to be blow the doors off? Well, we already know they're going to blow the doors off. Okay. What else? Anything else, guy?
That's it. I think Butters is back tomorrow. Is that right? Or
so.
Because people are longing for Butters as they should. EY from SoFi is back tomorrow.
I think she's going to be in the seat.
No kidding.
I think maybe.
So we got the band. That part of the band is back together. But that's it for today. We got to thank Doug Kass. I mean, his time is valuable. Thanks for spending it with us, Doug. And obviously our listeners and viewers. That's tremendous. Obviously, thank you, FactSet. As always, financial data and analytics powered by Tomorrow. Tomorrow we'll be back at 1 o'clock Eastern time. God only knows where the market's going to be, but we'll talk about it. We'll take criticism. We'll take compliments. But either way, we'll be here. Talk to you later, folks.
Sarah.